Hi, today we're going to discuss Chapter 5, Drilling and Developmental Costs, again using the Successful Efforts method. So last week we covered acquisition costs, and today we're going to talk about drilling and development cost. This is a short YouTube video about the general aspects of oil drilling. We're going to classify our costs between intangible drilling costs, we're going to shorten that for IDC, and equipment. These are both going to be capitalized, however they're going to be accounted for slightly different. So intangible drilling costs, IDC, does not have a salvage value. For example, the cost of roads, setting up a rig, drilling mud, grading and other dirt work area. It's necessary for the drilling of wells, and it's the items up to and including installing the Christmas tree. The Christmas tree is the valves, pipes, and fittings assembly used to control the oil and gas. IDC is going to be accounted for in a separate account versus the equipment. This is the lease and well equipment. These are tangible items. For example, well casings, pumps, and equipment. So again, you can see up after the Christmas tree, which is going to be the valves, pipes, and fittings. So to begin with, we're going to have intangible costs, and then those are going to be with no salvage value. And then after that, we're going to have the tangible costs, which are the lease and equipment, and typically these do have a salvage value. To review our types of reserves, we have our proved, which have a reasonable certainty from known reserves. Then we have further split into proved developed, recovered through existing wells and equipment, and proved undeveloped, recovered through new wells and equipment, undrilled or need major expenditure for completion. If the reserves are not proved, then they are considered unproved. And as we discussed in the previous chapters, these are accounted for differently. Another review of our well types. We can have exploratory wells that are going to be in an unproved area, and development wells in a proved area. We can also have service wells for the purpose of supporting production. These are going to be developmental wells, and they're going to be capitalized under both methods. And you may have a stratigraphic well. This is to obtain information and not to necessarily produce production. They can be exploratory well, or it can be a developmental well. To review, under successful efforts, if it's an exploratory well, if it's successful, it's going to be capitalized. If it's dry hole, it's going to be expensed. All of our developmental wells are going to be capitalized, successful and dry hole. So first, let's look at accounting for an exploratory well. So these are going to be during the drilling, they're going to be classified as wells in progress until it's determined. If we're going to have approved reserves, then it's going to be reclassified to wells and equipment. Or if the well is dry, it's going to be charged to dry hole expense. For example, on January 2nd, as a result of G&G work done in 2011, Tyler Company decided to lease 1,000 acres at $20 an acre. The lease was undeveloped. Lease acquisition costs are going to be capitalized. So we're going to debit unproved property for $20,000 and credit cash. Early in 2012, Tyler Company decided to begin drilling operations and had additional seismic studies conducted at a cost of $100,000 to select a specific drill type. Even though G&G work has been done to locate a possible reservoir, additional seismic work may be necessary to select the drill site. The cost of this seismic work is considered part of the cost of drilling the well and not G&G expense. So we're going to debit wells in progress, IDC, intangible drilling costs for $100,000, and we're going to credit cash. In preparing the drilling site, Tyler Company incurred costs of $25,000 in clearing and leveling the site and in building an access road. We're going to debit wells in progress, IDC, and we're going to credit cash. Additional preparation costs of $30,000 were incurred in digging a mud pit and installing a water line. Pipes for the water line cost $10,000. So we're going to split the costs. The amount for the digging a mud pit and installing a water line is going to be debited to wells in progress, IDC. The actual cost of the pipe is going to go to lease and well equipment for the $10,000. Tyler Company purchased casing for the well at a cost of $160,000. Casing is going to go to lease and well equipment. Tyler Company had hired a drilling contractor on a footage rate contract, and as is usual in such an agreement, payment was contingent upon the contractor drilling to a specified depth. The well was spudded, that just means it was begun early in June, and contract depth was reached in late July. Tyler Company paid the contractor $400,000. So these are actual drilling costs. So we're going to debit wells in progress, IDC, for the $400,000. In evaluating the well, Tyler Company incurred costs of $50,000. A well log was run and a drilled stem test was made. This is in evaluating the well, so we're going to debit wells in progress, IDC. Based on the well log and drill stem test, as well as other tests performed as the well was drilled, Tyler Company decided to complete the well. The casing was set at a cost of $135,000 for casing for the well and $60,000 for cementing services. So the amount for cementing is going to be intangible. So we're going to debit wells in progress, IDC, for the $60,000. And the actual casing is going to be debited to wells in progress, lease and well equipment for $135,000. Tyler incurred acquisition costs of $8,000 and installation costs of $1,000 for a string of production tubing through which the oil and gas will be produced. The amount for the string of production tubing, the actual tubing, is going to be debited to lease and wells equipment for $8,000. The installation costs, however, will be debited to wells in progress, IDC, for the $1,000. Tyler Company incurred acquisition costs of $50,000 for a Christmas tree and installation costs of $13,000. So the installation is going to be debited to wells in progress, IDC, for the $13,000. The amount for the Christmas tree equipment is going to be debited to wells in progress, lease and wells equipment for the $50,000. Tyler Company incurred $40,000 for perforating and acidizing services. This is just putting holes into the casing. So that's going to be intangible. We're going to debit wells in progress for IDC for $40,000 and credit cash. So the work on the well is finished and proved reserves have been found. 2 entries are necessary, one to transfer the cost of the well from an unfinished goods account to a finished goods account, and one to reclassify the lease as proved. So if you look at our wells in progress for $719,000, this is a summation of all of the debits to that account. We're now going to reclassify that to wells and equipment. So you can see we're going to debit wells and equipment for IDC, and we're going to credit wells in progress, IDC. Also, the amount that was debited to lease and well equipment, wells in progress, we're going to debit to wells and equipment, lease and well equipment for $363,000. That's being reclassified from the wells in progress for lease and well equipment, $363,000. In addition, the $20,000 that we had debited to unproved property, we're now going to reclassify to proved property. So we're going to debit proved property, $20,000, and we're going to credit the unproved property for $20,000. Tyler Company purchased pipes, storage tanks, and separators for a cost of $15,000 with installation costs of $1,000. We're going to debit wells and equipment, lease and well equipment for $16,000. Or instead of the well being successful with some reserves, if the well had been dry and we decided not to complete the well, we would make this entry. If after evaluating the well in Part G, Tyler Company instead had decided the well was dry, only costs in Parts A through G would have been incurred, and the entry to record the dry hole would have been, we would have reclassified the amounts in our wells in progress, IDC for $605,000. We would debit dry hole expense, IDC, for $605,000. In addition, the amount of $170,000 that had been debited to wells in progress, lease and well equipment, we would now record to dry hole expense, lease and well equipment, the amount of $170,000. And of course, we would not have had to reclassify the unproved property. Costs of $2,000 were incurred in plugging and abandoning the hole. So we would debit tri-hole expense and tangible drilling costs for $2,000 and credit cash. Now we're going to look at the entries associated with drilling a developmental well. We're going to classify them as wells in progress until they're complete. And then when it's completed, we're going to capitalize it to wells and equipment. So remember, since it's a developmental well, both the successful and the dry holes are going to be capitalized to wells and equipment. So most of the entries are the same as if it had been an exploratory well. So we're going to skip to L. The work on the well is finished and proved reserves have been found. 2 entries are necessary, one to transfer the cost of the well from an unfinished goods account to a finished goods account, and one to reclassify the lease as proved. So you can see this entry is similar to the entry in L for an exploratory well. However, we would not have to make the reclassification to proved property because it would already have been recorded as proved property. So I've noted the change in red. Tyler Company purchased pipes, storage tanks, and separators for a cost of $15,000. Installation costs were $1,000. So this is the same as if it was an exploratory well. We would debit wells and equipment for lease and well equipment for $16,000, and we would credit cash. If it had been decided that the well was dry, our journal entry would be slightly different than it was when it was an exploratory well. We would record it to wells and equipment, IDC, and wells and equipment, lease and well equipment, instead of expensing it to a dry hole. The amounts, however, are going to be the same. So the difference is we would be capitalizing it, even though it was dry, because of the fact that it is a developmental well. And the last entry, the $2,000, instead of expensing it to dry hole expense for an exploratory well, we would capitalize it to wells and equipment, IDC. And that concludes Chapter 5.